The US dollar to Japanese yen has bounced back, fully recovering its post-intervention losses and trading above key psychological levels. This rebound comes as the Bank of Japan's bond buying programs clash with the Ministry of Finance's efforts to support the yen. Today, we'll delve into why the market perceives these recent interventions more as liquidity events rather than true trend reversals, and why the BOJ's attempts to reduce its balance sheet aren't providing the support the yen desperately needs. As we entered this week, the Ministry of Finance stepped into the market, responding to the yen's plunge toward multi-decade lows. Leveraged funds were heavily short on yen, largely due to the stark interest rate gap between the Federal Reserve and the Bank of Japan, which, despite moving away from negative rates, is still committed to accommodative policies. Traders had their eyes fixed on the critical 155 and 160 levels on US dollar to Japanese yen, anticipating a defensive response from Tokyo. Here's where the policy friction becomes evident. The Ministry of Finance has been selling dollars to stabilize the yen, while the Bank of Japan continues its purchases of Japanese government bonds to keep yields steady. This dual approach effectively dilutes the impact of the interventions, as US dollar to Japanese yen saw a brief dip before bouncing back. Additionally, the BOJ's long-term JGB holdings fell by 44.6 trillion yen year-on-year, pushing the 10-year yield toward 2.5%. Yet, this pace of quantitative tightening is still too slow to counteract global carry trade demand. Reactions from Tokyo's strategists are tinged with skepticism. An ex-Goldman Sachs chief FX strategist highlighted the fundamental ineffectiveness of official intervention while the BOJ continues buying JGBs to keep yields capped, arguing that these interventions simply offer better sell levels for those betting against the yen. A former head of Morgan Stanley's Tokyo branch echoed this sentiment, pointing out that even with quantitative tightening, the BOJ's balance sheet remains above 500 trillion yen. This suggests that without a significant reduction in holdings, upward pressure on yields, and consequently support for the yen, will persist. For those trading US dollar to Japanese yen, this policy mismatch creates a structural uptrend alongside high volatility. Meanwhile, Nikkei investors find some comfort as the yen's stability supports export-heavy sectors like autos. However, as Toyota's latest earnings show, cost inflation is beginning to squeeze margins despite high sales volumes. The transmission channel is clear. The BOJ's yield suppression is keeping the yen carry trade alive, making Japanese assets appealing to global investors, but also leaving them vulnerable to sudden hawkish shifts in Tokyo's policies. The local media in Japan, including outlets like Nikkei and Reuters Tokyo, are highlighting a green light from real wages. For the first time in months, real wages have increased for 3 consecutive periods. Analysts suggest this could be the critical factor prompting Governor Kazuo Ueda to consider a rate hike in June or July. While Western analysts focus on the Ministry of Finance, Tokyo journalists are turning their attention to the labor market as the real driver behind the next significant movement in bond markets. Current positioning indicates that speculative yen shorts haven't been eliminated by interventions, they've simply been refreshed at higher levels. Real money flows remain cautious, but we are witnessing a shift from Japanese autos to financials, with banks poised to benefit from the rising yield environment. Retail margin traders in Tokyo are reportedly maintaining long positions on US dollar to Japanese yen, betting that the Ministry of Finance won't be able to combat the broader macro trends arising from US-Japan policy divergence. Looking ahead, keep an eye on the 160 level for US dollar to Japanese yen. A break there could trigger another round of action from the Ministry of Finance. Also, watch the 10-year JGB yield. If it nears 3%, the BOJ may face significant pressure to accelerate its tapering efforts. Finally, upcoming speeches from Governor Kazuo Ueda will be scrutinized for any shifts in tone regarding the current accommodative stance, especially as the yen's weakness starts affecting domestic consumption through rising import costs. In our baseline scenario, the BOJ appears set to maintain a slow pace of quantitative tightening, pushing US dollar to Japanese yen toward 162 with intermittent interventions from the Ministry of Finance. A hawkish scenario could see the BOJ surprise markets with aggressive tapering, driving JGB yields above 3% and leading to a swift unwind of the yen carry trade. On the flip side, a dovish scenario might unfold if US data weakens, forcing the Fed to pivot faster than the BOJ can adjust, stabilizing the yen without necessitating direct action from Tokyo. Traders should be prepared for the potential of a hawkish spike. To wrap up, intervention has yet to disrupt the yen's primary downtrend, and the Bank of Japan's yield caps remain the main barrier to currency strength. Keep an eye on Japanese real wages as a sleeper data point that may signal the next policy shift. Remember these critical levels: 160 for US dollar to Japanese yen and 2.5% for the 10-year JGB. For daily updates on the macro forces shaping Tokyo's markets, subscribe and hit the bell. This has been your Tokyo Macro Daily.